$72 million quarter over quarter on stronger product margin, lower operating expenses, and a favorable compare due to period costs in Q2. Before discussing Intel Foundry, I want to acknowledge the tireless effort of the Nvidia and Intel teams. There's a lot of work in front of us, but the collaboration we announced this quarter was the culmination of almost a year of hard work with a company that cuts no corners and prioritizes engineering excellence above all. The x86 architecture has been the foundation of the digital revolution that powers the modern world. AI is the next phase of that revolution, and we're on a path to ensure x86 remains at the heart of it. Engagements like this one with Nvidia are critical to this effort. Moving to Intel Foundry, Intel Foundry delivered revenue of $4.2 billion, down 4% sequentially. In Q3, Intel Foundry delivered Intel 10 and 7 volume above expectations, met key 18A milestones, and released hardened 18AP PDKs to the ecosystem. Foundry also advanced the development of Intel 14A and continues to make progress expanding its advanced packaging deal pipeline. Intel Foundry operating loss in Q3 was $2.3 billion, better by $847 million sequentially, primarily on favorable comparison due to the approximately $800 million impairment charge in Q2. As Lip-Bu discussed, our confidence in the long-term Foundry TAM continues to grow, bolstered by accelerating deployment and adoption of AI and the growing need for wafers and advanced packaging services. Projections are calling for a greater than 10x increase of gigawatts of AI capacity by 2030, creating significant opportunities for Intel Foundry with external customers, both for wafers and our differentiated advanced packaging capabilities like EMIB-T. We continue the work to earn the trust of our customers, and our improved balance sheet flexibility will allow us to quickly and responsibly respond to demand as it comes. Turning to all other, revenue came in at $1 billion, of which Altera contributed $386 million, and was down 6% sequentially due to the intra-quarter closure of Altera. The three primary components of all other in Q3 were Mobileye, Altera, and IMS. Collectively, the category delivered $100 million of operating profit. Now turning to guidance. For Q4, we're forecasting a revenue range of $12.8 to $13.8 billion. At the midpoint and adjusting for the Altera deconsolidation, Q4's revenue is roughly flat quarter over quarter. We expect Intel products up modestly sequentially, but below customer demand as we continue to navigate a tight supply environment. Within Intel products, we expect CCG to be down modestly and DCAI to be up strongly sequentially as we prioritize wafer capacity for server shipments over entry-level client parts. We expect Intel Foundry revenue up quarter over quarter on increased Intel 18A revenue and its external Foundry revenue up due to the deconsolidation of Altera. For all other, which now excludes Altera, we expect revenue to decline consistent with Mobileye's guidance, partially offset by sequential growth in IMS. At the midpoint of $13.3 billion, we forecast a gross margin of approximately 36.5%, down sequentially due to product mix, the impact of the first shipments of Core Ultra 3, which has the typically higher cost you see in the early stages of a new product ramp, and the deconsolidation of Altera. We forecast a tax rate of 12% and EPS of 8 cents, all on a non-GAAP basis. We expect non-controlled income to be approximately $350 to $400 million in Q4 on a GAAP basis, and we forecast average fully diluted share count of roughly 5 billion shares for Q4. Moving to CapEx, we continue to anticipate 2025 gross capital investment will be approximately $18 billion, and we expect to deploy more than $27 billion of CapEx in 2025 versus $17 billion deployed in 2024. I'll wrap up by saying we exit Q3 with a significantly stronger balance sheet, solid demand in the near term, and growing confidence in our core x86 franchise, as well as the longer-term opportunities in Foundry, ASICs, and accelerators. We also recognize the work we need to do to reach our full potential. We continue to add external talent, and unlock our workforce to improve our execution across product and process development, as well as manufacturing. We will closely manage what's in our control, react quickly as the environment evolves, and focus on delivering long-term shareholder value. At this time, I'll turn it back to John to start the Q&A.
Thank you, Dave. We will now transition to the Q&A portion of our call. As a reminder, we ask each of you to ask one question and a brief follow-up where applicable. With that, Jonathan, can we take the first question, please?
Certainly. And our first question comes from the line of Ross Seymour from Deutsche Bank. Your question, please.
Hi, guys. Thanks for the answer question, and congratulations on the strong results. Lip-Bu, the first one for you is going to be on the foundry side. You guys announced a ton of collaborations in the quarter. You very much strengthened your balance sheet, and the tone you took in your preamble sounds much more confident on the progress you're making in foundry. Do any of these collaborative announcements or equity investments go into that increased confidence, or are there some sort of technical merits that you're seeing that are rising your optimism in that part of your business?
Yeah, Ross, thank you so much for the questions. So I think a couple of announcements we make is, I think, clearly more on the product side. And also one is the SoftBank, because they're building up all the infrastructure, AI infrastructure, that definitely would need more capacity on the foundry side. So I think that would be the answer. But meanwhile, I think saying that, I think clearly from what I received from the 18A and 14A, we make tremendous good progress. The steady progress on 18A, and Panther Lake would depend on it. And then clearly we see the yield in a more predictable way. And I visit Fab 52 that fully in operation for the 18A. And then on the 14A, clearly we're engaging with multiple customers in terms of milestone basis. And we also really driving some of the yield and performance reliability that I'm seeing improvement. And also more exciting, the advanced packaging, we also see important demands from some of the key customers from foundry, from the cloud able and also enterprise side. So I think overall, I think we're looking quite excited to build this long-term trust with some of the customers and scaling it. And we also focus on hiring some of the top talent, driving some of the process technology improvement.
Ross, do you have a follow-up question?
Yeah, I do. One for Dave on the gross margin side of things. You talked through the upside in the third quarter and the sequential downside in the fourth. But could you just walk us through some of the pluses and minuses as we think about 2026, just kind of directionally? And I guess where I'm going is it seems like the biggest improvement has to come on the foundry gross margin side of things. Is that the biggest driver? What drives it? And as those gross margins go up, does that have any impact on the Intel products gross margin?
Yeah, sure, Russ. So, obviously we're not going to guide 26, but I think I can give a little bit of color. I think first of all, just be mindful that Altera is out of the numbers in 26. They were in a large part of the numbers for 25. So that's probably a point of margin headwind for us because they were accretive to our gross margin. So that's going to be a little bit of a challenge to overcome it. I'd say, we still believe in this 40 to 60% fall through for margins. Of course, it's a little bit of a range you could drive a truck through, quite honestly, but a lot of it's because of mix. I mean, we'll have, obviously Lunar Lake will be a big component at least in the first half of the year, and that is a dilutive product to us. And then Panther Lake, while obviously is going to be a great cross structure for us over time, given the wafers are fabbed internally. Initially, obviously, when you got a new product on a new process, they're pretty expensive products to start with, and so it's dilutive, in the beginnings of the year, and then it gets better over the course of the year. I do agree. We should see gross margins improve on the foundry side for sure. Partly that is the scale dynamic that we will see benefit from, but also, as we move towards more leading edge mix. In 18A for sure, but also even Intel 4 3, those products have better pricing and a better cost structure. And so those margins should be accretive. And really, the dynamic about how much it improves will largely be a function of, how the mix plays out through the year.
Jonathan, can we have the next question, please?
Certainly. Our next question comes from the line of Joseph Moore from Morgan Stanley. Your question, please.
Great. Thank you. I was really interested in a lot of the prepared remarks around the sort of differences to your approach to foundry. And you talked about this last quarter and this quarter that you're sort of looking for customer commitments before you make the investment. Can you just talk about how those conversations are going? And I certainly, I can see the trade-off from customer standpoint. They're making a commitment to you. Do they expect that capacity to be built ahead of time? Just, is there a bit of a chicken and egg aspect to these investments, and just how are you approaching those conversations?
Yeah, Joseph, thank you so much for the question. I think on the foundry side, clearly we are engaging with multiple customers. And as building the trust of the customer, you need to really show the yield improvement, reliability, and also you need to have all the specific IP that they require. It's a service industry. You need to have all the right IP. That's why I formed the central engineering to get all the right IP to matching with the customer requirement. And then, I think the best way is really, show the performance, the yield, and then we can get the test chip so that they can really work on it. And then they can starting to deploy their most important revenue wafer to depend on us so that we can drive their success for them. So I think those are very important. In terms of potential investment and collaboration, I think with the different customer, different requirement, we're working with them. But more important is to get their commitment to the foundry and the support. I think that's building the trust that's more important.
Yeah, maybe just to add on, I would say that, I think customers understand that it takes time from the time you deploy capital to the time where you have output. And so, our expectation is we'll get those commitments firmed up in time to deploy the capital, in time to meet the demand. I'd also say we're in a reasonably decent position given the CapEx investments we've already made. So we have a lot of the assets on the books and in what we call assets under construction. We've made a lot of investments around the shell space. So we do see line of sight to driving a reasonable amount of supply for our external foundry customers with our existing footprint, and quite honestly, with the use of the assets under construction and reuse of equipment that we have on the books today. So I think we have flexibility. Obviously, if things go better, we may be looking to invest more and do that more quickly, but we feel reasonably confident we can react to the situation.
Joe, do you have a follow-up question?
I do, yeah. Separately, the supply constraints in server CPUs and other CPUs, we see those in the market, I guess, but your growth was 5% sequentially, single-digit growth year on year. I guess, where is the shortage coming from? Is there just better demand ahead that you're not able to meet? Is it some of the transitions that you guys have made? Just, and I certainly see that tightness in the marketplace, so I'm not arguing with it, but I'm just curious, where you see that shortage coming from and how it'll get resolved.
Yeah, I mean, shortage is pretty much across our business, I would say. We are definitely tight on Intel 10 and 7. Obviously, we're not looking to build more capacity there, and so as we get more demand, we're constrained. In some ways, we're living off of inventory. We're also trying to kind of demand shape to get customers to other products. There's also shortages even beyond our specific challenges on the foundry side. I think there's widely reported substrate shortages, for example. So, obviously, I think the demand, there was a lot of caution coming into the year, I think, across the board. And it looks like things are going to be stronger this year, and probably that continues well into next year. And, I think everybody is, trying to manage through it.
Jonathan, can we have the next question, please?
Certainly. Our next question comes to the line of C.J. Muse from Cantor Fitzgerald. Your question, please.
Yeah, good afternoon. Thank you for taking the question. I guess a follow-up on the current outlook for demand outpacing supply into 2026. Curious if that's a comment largely focused on server or also including client, and I guess depending on your thoughts there, how should we be thinking about Q1 trends versus normal seasonality, which typically, I guess, would be down high single digits, low double digits?
Yeah. It's both, although, as we said, we are yielding a bit of the small core market in client to fulfill customer requirements more broadly and on the client space and more specifically in the server space. So that's how we're kind of manage it. As you look into Q1, obviously, again, this is something we'll probably give you a lot more color around in January. I would just say, we may actually be at our peak in terms of shortages in the first quarter because we've lived through the Q3 and Q4 with a little bit of inventory to help us and, just cranking the output as much as we could with the factory. We probably won't have as much of that luxury in Q1. So I'm not sure we'll buck the trend on seasonality, given the fact that, we're going to be really, really tight in the first quarter. After that, I think we'll start to see some improvements and, we can get ourselves caught up as we get through the rest of the year.
CJ, do you have a follow-up question?
I do, John. Thank you. I guess given the investments from the U.S. government and Nvidia, SoftBank, et cetera, I'm curious with that improved cash position and liquidity, how has your thinking evolved in terms of investments in either CapEx or making other investments in your product businesses?
Yeah, I mean, obviously we're in a great position. I'd say, as we think about this cash, our first focus is to delever. I mean, that's one of the things we really wanted to, when Lip-Bu came in, he really was upset about the balance sheet. And so we've done a lot to work on that and improve that for him. We took $4.3 billion of debt off the books this quarter, and all the maturities next quarter or next year should come off, and we'll repay that. I think as you look at CapEx, it puts us in a position of flexibility on CapEx, but we want to be very disciplined around CapEx. So we will absolutely be looking at demand. Lip-Bu's been very direct with us on this. He wants to see the whites of the eyes of the customer that we can believe in that demand. And if that demand exists, of course, we will amp up the CapEx as necessary. As you think about investment, we still think that $16 billion of OpEx investment for next year is the right amount. Although Lip-Bu and I are constantly now looking at how we mix that $16 billion to drive the best possible growth and return for investors, and we will be making those changes. Beyond that, we'll see how things go. We want to be pretty disciplined about our OpEx as a percent of revenue and drive leverage. But we do see opportunities to make investments that can, I think, deliver great returns for shareholders, and we're not afraid to do that either.
Jonathan, can we have the next question, please?
Certainly. Our next question comes from the line of Blayne Curtis from Jefferies. Your question, please.
Hey, guys. Thanks. I had two. Just on the CapEx, I think you reiterated $18 billion, but I think you spent, I guess, less than I was modeling Q3. So is that really still the number? And I'm just kind of curious, as you start to ramp this 18A in Arizona, is there a way to think about the timing of when you add capacity there?
On the $18 billion, yeah, I think that's still the number. Obviously, CapEx can be lumpy. It depends on when things get, when all the requirements associated with paying the invoice are completed. That's when we make the payments, and so we would expect to be somewhere in that range. Obviously, there's an error bar around that. It might be a little bit less or a little bit more than that. 18A, we still have to ramp this. I wouldn't expect significant capacity increases in the near term. But I think, as we said, we are not at peak supply for 18A. In fact, we don't get there until the end of the decade. And we do think that this node will be a fairly long-lived node for us. And so we will continue to make investments on 18A over time. There will be CapEx investments next year, but I wouldn't expect the supply to, at least capacity, to significantly change vis-a-vis our expectations right now.
Blayne, do you have a quick follow-up?
Yeah, thanks, John. I wanted to follow up on the gross margin trajectory as 18A layers in. I know, comparing it to probably the prior couple nodes, not a great compare, but maybe to a successful one. When you say yields are in a good spot and improving, is there a way to think about where those 18A yields are versus a successful product that you've seen in your history, and kind of think about how that layers in the first half?
Yeah, I would say in general, I'm not sure yields in older nodes have been a big focus of ours, quite honestly. So we're blazing a new trail on this. Yields are, what I would say, yields are adequate to address the supply, but they are not where we need them to be in order to drive the appropriate level of margins. And by the end of next year, we'll probably be in that space. And certainly the year after that, I think they'll be in what would be kind of an industry acceptable level on the yields. I would tell you on 14A, we're off to a great start. And if you look at 14A in terms of its maturity relative to 18A at that same point of maturity, we're better in terms of performance and yield. So we're off to an even better start on 14A. We just got to kind of continue that progress.
Jonathan, can we have the next question, please?
Certainly. Our next question comes from the line of Stacy Rasgon from Bernstein Research. Your question, please.
Hi, guys. Thanks for taking my questions. I wanted to go back and ask about these supply constraints again. So you talked a lot about how AI was driving a lot of demand across servers and across PCs, but at the same time, it doesn't look like customers want your AI products. In fact, they can't get enough of the older stuff. So I guess, you must have plenty of supply for Granite and for Meteor and even for Lunar Lake. So how are you going to get the customers off of the older products where they haven't shown any desire to get off of them so far, even given the constraints that they've been under? And I guess, how do we think about the transition of those customers? Because you're clearly, you even said it yourself, you're not adding any more of the older capacity. In fact, you took some of it offline, right?
Yeah, good question, Stacey. I think it's a misnomer to say AI hasn't done well. I mean, it was sequentially up double digits quarter over quarter. And, we talked about a number of we would ship about 100 million units by the end of this year on AI PC, and we're going to be first order in that range. So I think it's going pretty well. Clearly, though, the older nodes have also done well, and that was probably the part that was more unexpected. I think we've just got to participate in making sure that the ecosystem drives enough applications for AI in the PC space, and we work with the ISVs regularly to drive that. They're getting there. It's like any market, it starts relatively immature and kind of builds out over time. But even in our company, we're starting to find uses for AI PC. In fact, IR is coming up with one here that we'll be using. So I think it's just kind of time. Now that said, what clearly is happening is the Windows refresh is happening more significantly than I think we expected, and that's not necessarily an AI PC story. And so Raptor Lake is also a product that addresses that, and so we're just seeing upside in that part of the market as well.
Stacy, do you have a follow-up?
I do, thank you. Dave, I want to follow up on two things that I think I heard you say on 18A. I thought I heard you say, number one, that yields would not be in a great place, at least until the end of next year. Mm-hmm. And then I thought I also heard you say that we're not going to be adding a lot of 18A capacity next year. Did I hear those wrong? I mean, how can, especially the latter one, how can that be true if you're ramping Panther, or is that like a
sure? I mean, we're obviously at our infancy. And what I'm saying is, relative to the CapEx plan, it's not like we're going to incrementally add supply for 18A next year. But yes, of course, we're going to be ramping the volume over the course of the next year. I wouldn't say 18A yields are in a bad place. I mean, they're where we want them to be at this point. We had a goal for the end of the year, and they're going to hit that goal. But to be, fully accretive in terms of the cost structure of 18A, we need the yields to be better. I mean, that's like every process. That's what happens, and it's going to take all of next year, I think, to really get to a place where that's the case.
Jonathan, can we have the next question, please?
Certainly. Our next question comes from the line of Joshua Buchalter from TD Cowen. Your question, please.
Hey, guys. Thank you for taking my question. I wanted to ask about some comments Lip-Bu made in the prepared remarks about fixed function computing and potentially supporting more ASICs. Was this, maybe could you provide more context on the scope of this? Is this for potential foundry customers, or are these products? And if it's products, what types of applications do you expect to be supporting with custom silicon? Thank you.
Good question. So I think, first of all, I just mentioned about the central engineering. We are driving the ASIC design, and that will be enhanced. Actually, it's a good opportunity for us to extend our reach of the core x86 IP, and also drive some of the purpose-built silicon for some of our system and cloud player and customer. And then definitely with the foundry and packaging, also that were helping us in terms of their requirement. So in all, I think this AI will be driving a lot of growth, especially in the double down, the Moore's law, and that will help us a lot in our 86 uplift. And then and there's opportunity for us to build a whole ASIC design to serve some of the customer requirement.
Josh, do you have a quick follow-up?
Yeah. So on the last quarter, obviously the disclosure that you may decide to abandon 14A got a lot of attention. I just wanted to ask, given your balance sheet is in a lot different spot than it was 3 months ago, has anything changed from that regard? I mean, I don't think the Q's out, so I haven't seen if any of the language changed there. But was curious if anything had moved around since last quarter, given all the changes in your balance sheet. Thank you.
Yeah, since the last quarter, I think clearly our engagement with the customer for 14 days increased. And we are very heavily engaging with the customer in terms of defining the technology, the process, the yield, and the IP requirement to serve them. And they clearly see the tremendous demand that they need to have Intel to be strong on the 14A. And so we are delighted and more confident. And meanwhile, we're also attracting some of the key talent for the process technology that can really drive success. And that's why it gives me a lot of more confidence to drive that.
Jonathan, can we have the next question, please?
Certainly. Our next question comes from the line of Ben Reitzes from Melius. Your question, please.
Hey, thanks, guys. Lip-Bu, can we get an update on the Nvidia relationship? Timing of products, have you gotten any feedback from customers in terms of your ability to articulate on the materiality of the relationship and in terms of timing and materiality or any other color you want to give us on that? Thanks so much.
Sure, thank you. And this is a very important collaboration with Nvidia. It's a great company, as you guys know, and I've been known as a friend of Jensen for more than 30 years. And we are very excited about this effort of Intel CPU 86 leadership and their unmatched AI and accelerated computing, and then connecting with their NVLink, and that will be really create a new class of product in the multi-generations. And this is something that very heavy engineering to engineering engagement, and that will be driving some of the new product that custom data center and PC product, and that really optimized for the AI era. So I think all in all, I think this is going to be multiple years of engagement and then addressing a market that we are excited and also driving some of the requirement for the AI infrastructure.
And maybe just one more addition. What makes this really special for us is it's not attacking our existing TAM. It's an incremental opportunity for us to expand the TAM. And so, these are great opportunities for us.
Ben, do you have a follow-up?
Yeah, thanks, John. Lip-Bu, you mentioned, a little bit about your AI strategy now, to attack the inference market, and that you see room for, Intel solutions. And it sounds like you're going to partner a lot there. Is this strategy, more about partnering? Is it more about, is there a specific Intel IP, for inferencing that you're excited about, or is it more of a Switzerland approach where you could partner with a lot of the existing players out there to attack more of the TAM? Thanks.
Yeah, good question. So I think first of all, I think with the AI driving a lot of growth, we definitely want to play in that. I think this is a very early inning, and so I think that's opportunity for us. And I think one area that we are focused on is our revitalizing our 86 and to really tailor to purpose-built CPU, GPU requirement for the new AI workload, and then really addressing the power-efficient agentic and managing all the different agents. This is a new way of compute platform of choice, and that will be also applying to the system and software. You're going to stay tuned. I think we're going to be partnering with some of the incumbents and also the emerging companies that are driving some of these changes.
Jonathan, can we have the next question, please?
Certainly. Our next question comes from the line of Timothy Arcuri from UBS. Your question, please.
Thanks a lot. Dave, it's not that often we see high fixed cost businesses that are constrained that have gross margins less than 40%. And I certainly get that most of this is because of the wafer costs for Intel 10 and 7, and you still have low yields on 18A. But I'm wondering, and this is probably a hard question to answer, but I wonder if you could maybe just kind of fast forward a bit and say, like, what would gross margin be if you were off of 10 and 7 and you were on 18A? Is there a way you could normalize it for us?
Yeah, I mean, obviously you may be listening in on some of my conversations with the team here, because that's definitely something I've been making the point of. I would say there's two dynamics, one of which you're hitting on, and that is the high cost of older processes versus the better cost structure for the newer processes. And that's obviously meaningful. I mean, we're in negative gross margin territory for foundry. That makes a meaningful improvement if you move it even into the positive territory. But the other aspect of our gross margins is a function of just the product quality. We're in reasonably decent shape on client in terms of product performance and competitiveness, with a few exceptions, but we're not where we need to be on a cost basis. And so we've got to make improvements there. And we have that on the roadmap. The team recognizes it, but that's a multi-year process to get there. But it's more pronounced on the data center side. Not only do we not have the right cost structure, but we also don't have the right competitiveness to really get the right margins from our customers. And so we've got work to do there. And so that's what Lip-Bu and the team he's pulled in are hyper-focused on, is getting great products at the right cost structure to drive better gross margins. That, to me, I think is the linchpin in all this. The improvements on the foundry side are just going to come, I think. We're going to mix higher and higher to Intel 3, 4, and then 18A and ultimately 14A. The cost structures of all of those are actually pretty similar, and it'll just be a function of the fact that the value that's provided by those leading edge nodes is going to be significantly more, and that's going to just materially drive the gross margins up. The other thing that I would say is we are seeing a lot of startup costs by virtue of the fact that we've jammed a whole bunch of new processes in kind of in rapid fashion. As we get into 14A, our cadence will be more normalized, and so you won't see so much startup costs stacked on top of each other, which is affecting our gross margins, and that's billions of dollars. So I think as you get beyond a few years, that rolls off and will also help.
Tim, do you have a quick follow-up?
I do, yeah. Lip-Bu, you didn't give an update last call on Diamond Rapids launch date. I know the whole roadmap's under review, but you did sound the company sounds fairly optimistic about Coral Rapids. Can you just give us sort of an update on the data center roadmap a bit here? Thanks.
Yeah, thank you. Good questions. So I think clearly the Diamond Rapids are getting stronger hyperscale feedback, and then we also focus on the new product, the Coral Rapids. And that will be included the SMT, the multi-threading, and that can drive higher performance. We're in the definition stage, and then we will work out the roadmap, and then we're going to execute that. Will be going forward.
Thanks, Tim. Jonathan, we have time for one last questioner.
Certainly. Then our final question for today comes from the line of Aaron Rakers from Wells Fargo. Your question, please.
Yeah, thanks for fitting me in here. Just a couple real quick ones. I guess going back to the Nvidia relationship, I can appreciate that the announcement was really tied to the NVLink fusion strategy and integrating that with the x86 ecosystem. But I think there's been some recent reports about maybe using Gaudi for some dedicated inference workloads within a stack of Nvidia. How do you, is this relationship, a starting point, and should we expect to see more potential integration beyond NVLink going forward?
Yeah, I think let me answer that. I think NVLink is kind of more the hub to connecting the 86 and GPU. In terms of the AI strategy, we are defining the Crescent Island that we talk about, and also we also have a new product line in the lineup, so they're addressing the agentic and the physical AI and more in the inference side. And so I think stay tuned. We will update that.
Aaron, do you have a quick follow-up?
Okay. I do, and I'll make it really short. Can you just update us on how we think about the NCI, the non-controlling interest expense, as we look through this year and think about that? I think you've given some comments in the past of how we should think about that into 26. Thank you.
Yeah, I think 26, we're looking at somewhere in the $1.2 billion to $1.4 billion range is probably a good estimate. Obviously, we're focused on that, and we'll work to minimize that as much as possible.
With that, I want to thank everyone for joining us today. We are on the journey of rebuild Intel, and we have a lot of work ahead of us, but we are making solid progress in Q3. I look forward seeing many of you throughout the quarter and provide you another update in January.
Thank you, ladies and gentlemen, for your participation.